Well, AI heavyweight Nvidia is set to report results after the close on Wednesday. For those thinking of buying the stock before earnings, we've got to look at what your return could look like based on past performance. Here with the breakdown, markets and data editor and host of Stocks in Translation, Jared Blikre. Hey, Jared.
Hey, Maddie. Well, we've been talking about the breakdown in the Mag 7, and let's talk about the poster child, Nvidia, down 10% for the year, and we are just showing a year-to-date chart. This is frustrating for traders, but we've seen this before, and a lot of times the earnings has been a catalyst for both the bulls and the bears. So let's break down the earnings reactions over time. I'm going to go back 10 years here, and I'm looking at the average and median returns of various time frames after the report. So here is one day. You can see a median result of 3.4% to the upside. For 1 week later, it's a median of 4.3%, and for 1 month, pretty much sticking within this range, also 3.4%. And you can see the percentage positive going pretty sideways as well, 63, 68, 60. Anything less than a 70, I don't really think is too bullish, just because US stocks tend to go up. But it gets interesting. 1 quarter out, we see the average or median returns up 17.5%, and then the percent positive goes up to 74%. But the real magic happens if you're holding for a longer period of time. 1 year returns tend to be 112%. That is a huge amount, basically doubling over a year. And this goes back 10 years, let's remember. And then the percentage positive shoots up to 84%. Very strong results there. But I've seen many times over the last few years, especially within the pandemic or post-pandemic, the tendency has been, and there's been a few examples of this, for the earnings reaction to be suddenly reversed. So there have been times when it jumps up to a new high. The next day, everybody gets excited, loads up even more, and then it only crashes down. So I think that dynamic is kind of what we're looking at right here. So the message for traders is probably want to be a long-term holder unless you're extremely adept at navigating these short-term vicissitudes. Now, I want to get into the weeds a little bit by looking at options implied volatility. This is a very simple concept. Measures investors' expectations of future price swings based on options prices. So we look at the options market, and those traders' opinions are being reflected in that, and we come up with some numbers here. The options implied volatility for the 1 day after the announcement is 8.5%. Now, the prior 2.5-year average here in the actual reaction was a bit higher, 11.1%. So options traders are not expecting as big a reaction actually as we have seen historically, just based on this metric. And then we have the average daily movement since the last earnings, excluding that earnings day. So if you take out the big day after earnings reaction, you only see volatility of about 4.3%. So the bottom line is we can expect a doubling or even a tripling. That would be nothing. That would be no sweat for Nvidia on Thursday. And that's the earnings reaction day that we want to pay attention to. So you wrap it all up. We have something for the short-term traders and the long-term traders here, but the long-term traders definitely have it a lot easier, at least with respect to Nvidia.
All right, Jared, thanks so much. And of course, we're going to have coverage of the every move that we're seeing in the stock's reaction following those results on Wednesday after the bell. And then, of course, with us as we kick off our opening bell coverage on Thursday morning. Jared, thanks.